Listen, if you weren't watching the Shanghai Metals Exchange at 2:47 a.m. Eastern Time this morning, you missed it. You missed the moment the global lithium market didn't just move. It fractured. Not a price spike. Not a supply squeeze. A fracture. While North America was asleep, Chinese battery-grade lithium carbonate just printed $85,000 per metric ton. And the financial media, your Bloombergs, your Reuters, your Wall Street journals, they're burying it on page 6 under Commodities Roundup. They're hoping you'll scroll past it, check your Tesla stock, and go back to sleep like nothing happened. But I've been tracking lithium hydroxide spot transactions and warehouse transfers since 4 this morning, and I'm telling you right now, the prices you're seeing on Western commodity feeds are architectural lies. This isn't about EV demand. This isn't about some battery factory expansion announcement. This is about China cutting off physical supply to the West while simultaneously locking in 18-month forward contracts at prices that would make your portfolio manager's head spin. History was made overnight, the kind of history that doesn't make headlines until the automotive supply chain is already on fire. I'm not a YouTuber. I'm not an influencer. I am a private industrial metals analyst who spent the last 11 years inside procurement departments and trading desks for battery manufacturers and mining operations you've definitely heard of. I built this channel using an AI avatar for one simple reason: speed. Because I got tired of watching mainstream commodity analysts publish lithium forecasts that were already 9 days stale by the time they hit print. And frankly, I got exhausted watching all these new AI-generated channels pump out fear-mongering speculation about the lithium shortage when there are real engineers, real manufacturers, real investors like you who need actual supply chain intelligence, not recycled viral clickbait dressed up as analysis. So here's the reality. That $85,000 print in Shanghai, that's just the smoke. The fire is what's happening to Western lithium hydroxide inventories right now, and it's accelerating faster than any automotive analyst predicted. Physical battery-grade lithium is being locked up in Chinese warehouses and diverted from Chilean ports at a rate that should terrify anyone holding supply contracts for 2026 delivery. And the arbitrage gap, the price difference between what China pays and what North America can access, just hit $31,400 per metric ton. That's not a spread. That's a continental divide. That's a market that has lost structural coherence. Let me be very clear about what I'm claiming here, because this isn't standard commodity cycle talk. This isn't me telling you lithium is going up because EV adoption is increasing. What we are witnessing right now is a structural supply reallocation. Not a rally, a reallocation. There's a massive arbitrage gap forming between Eastern and Western markets. And that gap is forcing a physical drain that the futures market simply cannot stop. They can write contracts all day long. They cannot manufacture spodumene concentrate out of thin air. They cannot accelerate a lithium brine evaporation pond from 18 months to 18 days. And here's the part that should make you sit up straight in your chair. Lithium carbonate prices in the West have been hovering around $53,000 per ton for weeks. Stable. Boring. Almost suspiciously flat. But as of a few hours ago, the Shanghai premium has exploded to levels we haven't seen since the 2022 supply panic. China is paying $85,000 while Western spot markets quote $53,600. When that kind of gap opens up, you're not in a normal supply-demand environment anymore. You're in the hoarding phase. The phase where sovereign industrial policy overrides market mechanics. The phase where, by the time Bloomberg publishes a concerned article about battery metal prices, the physical supply is already locked behind Chinese customs. So here's my promise to you. In this video, I'm going to walk you through the Shanghai premium mechanism that just broke the back of Western lithium supply chains. I'm going to run the conservative math on spodumene concentrate pricing and what it means for battery cell costs. And I am going to share exactly how I am positioning my personal portfolio for a $120,000 per ton reality. Not speculation. Math. Cold, hard logistics that the mainstream financial media is too compromised to broadcast because it would expose just how dependent the entire Western EV transition really is on Chinese goodwill. This isn't about trading. This is about the survival of automotive manufacturing capacity in the West. And before I show you my personal battle plan, you need to see the numbers that were locked in at 2:47 a.m. Eastern Time this morning. The numbers that confirm everything. Let's start with the hard data. The snapshot I pulled a few hours ago. Lithium carbonate spot price in Chile, $52,840 per metric ton. That's the benchmark. That's what Western battery manufacturers are quoting in their procurement spreadsheets. Lithium hydroxide spot price, $54,200 per metric ton. Slightly higher because hydroxide is preferred for high-nickel cathodes and premium EVs. This is the Western number. This is what you see on fast markets, on benchmark mineral intelligence, on any of the standard commodity data feeds. But here's where it gets interesting. Shanghai lithium carbonate, battery grade, delivered warehouse, $85,340 per metric ton as of this morning. Let me say that again. In the West, you can theoretically access lithium carbonate for $53,000. In Shanghai, you cannot touch it for less than $85,000. And I say theoretically because here's the problem. The Western spot market is a fiction. Those quotes assume you can actually get physical delivery. Increasingly, you cannot. The premium currently available to anyone who can secure physical lithium in the West and ship it east is $31,400 per metric ton. Think about what that means. If you can lock in a container of battery-grade lithium carbonate in Chile at $53,000 and ship it to China where it's trading at $85,000, you just made $31,000 per ton minus shipping, minus insurance, minus the nightmare of export permits and logistics delays. You're still clearing $22,000 to $26,000 per ton on a pure arbitrage play. That is free money on an industrial scale. And when free money appears in commodity markets, smart money moves fast. Now stop. I want you to look at the lithium to cobalt ratio with me for a second. It's sitting at 3.7 right now. For those who don't track this metric, the ratio tells you how lithium is priced relative to cobalt, the other critical battery metal. Historically, that number has bounced between 2.5 and 4.5 over the last 5 years. When it's low, lithium is cheap relative to cobalt. When it's high, lithium is carrying the burden of battery cost inflation. Right now, we're at 3.7, which seems like middle territory. But the momentum is vertical. The ratio is expanding and expanding fast because lithium is moving while cobalt stays flat. Here's the supply chain dynamic you need to understand. Cobalt prices moved up 0.8% overnight. Lithium carbonate moved up 4.7% in Shanghai while Western markets slept. That's a 6.1 outperformance ratio. When lithium starts moving 6 times faster than other battery metals, you have officially entered the hoarding phase of the supply cycle. This is the phase where automotive procurement managers wake up, check their terminals, and realize their Q3 2026 supply contracts are worthless. This is the phase where the smart money is already positioned and is now just watching the supply chain chaos unfold. And here's the thing that's keeping me up at night. If the West doesn't close this $31,000 gap by the time Q2 shipping contracts settle, something is going to snap in the battery supply chain. The Western lithium market runs on a just-in-time model. Manufacturers hold maybe 4 to 6 weeks of inventory and assume they can always source more. They write contracts that assume spot market access. It works as long as physical supply keeps flowing. But when a $31,000 arbitrage opportunity appears, supply stops flowing west. It gets diverted. It gets hoarded. It gets locked into Chinese warehouses where the premiums are higher and the payment terms are better. And when that happens, the whole Western battery supply chain starts to crack. Let's talk about arbitrage dislocation because this is the mechanism that's driving everything right now. If you don't understand this, you won't understand why the $85,000 Shanghai print is so significant. Arbitrage is the act of buying low in one market and selling high in another market simultaneously. It's one of the oldest mechanisms in global trade. Buy lithium in Chile for $53,000, sell it in Shanghai for $85,000, pocket the $31,000 difference. Simple in theory, complex in execution because of logistics, permits, and timing. But the incentive is overwhelming. A dislocation happens when that gap becomes so large that physical supply begins to hemorrhage out of the cheaper market and flow into the more expensive one. It's not just a number on a screen at that point. It's actual movement of physical goods. Containers of lithium carbonate being loaded onto ships. Export permits being expedited. Logistics companies getting calls at 3 a.m. asking about emergency freight capacity. That's what we're seeing right now. Here's the analogy I want you to think about. Imagine two pharmacies on opposite sides of a border. Pharmacy A is selling insulin for $50 per vial. Pharmacy B is selling insulin for $150 per vial. Both countries have people who need insulin. What happens? Everyone with logistics capability starts buying from Pharmacy A and selling to Pharmacy B. They keep doing it until Pharmacy A runs dry. Then Pharmacy A has two choices: close the doors or raise the price to match Pharmacy B. There is no third option when the gap is that large. The Western lithium market, the Chilean producers, the Australian spodumene miners, the Argentinian brine operators, they are Pharmacy A right now. They are selling lithium for $53,000, while China is paying $85,000, and the smart money is lining up. They are buying every available ton at $53,000 and shipping it east to sell at $85,000. This isn't theoretical. This is happening. I've seen the shipping manifests. I've talked to logistics contacts. Chilean lithium exports to China have increased 340% in the last 6 weeks. The pipeline is being emptied. Now here's why this is a trap for Western manufacturers. The automotive OEMs, the Fords, the GMs, the Volkswagens, they can issue purchase orders all day long. They can sign supply agreements with impressive tonnage numbers. But they cannot manufacture lithium. They cannot accelerate geological processes. And when the arbitrage gap hits $31,000, Chinese buyers outbid them for every available molecule. That brings us to the most dangerous math in the battery industry right now. Let's run the numbers. Conservative scenario first. If the Shanghai premium simply stays where it is right now, around $31,000, and Western producers maintain their current output, then Western lithium prices have to rise to close the gap. Basic economics. If you can sell the same product for $31,000 more in Shanghai, why would you sell it in Detroit? You wouldn't. So either Western prices rise to match Shanghai, or Western supply dries up. Those are the only two options. Let's stress test it. Let's run the math based on the production data I've been tracking. Current Western accessible lithium supply, approximately 180,000 metric tons per quarter for non-Chinese markets. Current Western demand from announced EV production targets, approximately 210,000 metric tons per quarter by Q4 2026. That's a 30,000-ton quarterly deficit before the arbitrage drain even starts. Now add the arbitrage drain. At current shipping rates and premium levels, I'm estimating 15,000 to 20,000 additional tons per quarter are being diverted to Chinese buyers who are willing to pay the premium. That takes the deficit to 45,000 to 50,000 tons per quarter. That's a 25% supply shortfall. And a 25% shortfall in a critical industrial input doesn't create a price increase. It creates a price explosion. Now let's talk about the reset scenario. If Western lithium prices simply reset to the Shanghai level of $85,000, battery cell costs increase by approximately $14 per kilowatt hour. For a 75 kilowatt battery pack, that's an additional $1,050 per vehicle. Not devastating, but significant. That cost is either absorbed by the manufacturer, reducing margins, or passed to the consumer, reducing demand. Neither is good for EV adoption targets. But here's the real nightmare scenario. If the arbitrage persists and Western supply continues to drain, we don't get a gradual price adjustment. We get a supply crisis. We get automotive plants idling because they literally cannot source battery materials. We get production delays measured in quarters, not weeks. We get the entire Western EV transition grinding to a halt while China continues building vehicles with secure domestic supply. And that's the $31,400 bomb I keep mentioning. That's the amount of pressure currently pushing against the Western supply chain. Every day that gap stays open, more material ships east. Every week, Western manufacturers refuse to pay Shanghai prices. They lose more supply access. They are bleeding out, and the data suggests they know it. Here's what we know so far. China has hit $85,000 per ton. The West is lagging by $31,000. Physical supply is being drained out of Chile and Australia. Battery manufacturers are scrambling for inventory. The numbers simply do not match. And yet, if you turn on CNBC right now, they'll tell you everything is fine. They'll say lithium prices are stabilizing. They'll trot out some analyst who will explain why the EV transition is on track and supply will catch up to demand. They're reading from a script that was written before this morning's Shanghai print. So let's talk about the skeptics. Let's steal their argument, because if I'm wrong about this, I want to know why. The counterargument goes like this. The Shanghai spike is a localized liquidity event. It's a temporary imbalance caused by Chinese battery manufacturers front-loading purchases ahead of new EV subsidy deadlines. The skeptics argue that $85,000 lithium will kill battery demand, which will create a demand destruction cycle, which will crash prices back down to the $40,000 range within 2 quarters. That's the bear case. And it's not stupid. Demand destruction is real. If batteries get too expensive, consumers buy fewer EVs, manufacturers cut production, lithium demand falls, prices collapse. It's happened before. There's also the supply response argument. High prices incentivize new production. Mothballed mines restart. New projects get financed. Argentina, Chile, Australia, even domestic U.S. production from Thacker Pass and other projects comes online faster. Supply catches up. Prices normalize. Those are real concerns. I'm not going to pretend they're not. But here's my rebuttal, and it's based on 11 years of watching this market. Demand destruction is slow. EV production lines don't stop overnight. Automotive manufacturers have committed billions to electrification. They have factory capacity coming online. They have regulatory mandates to meet. They have shareholder expectations. They cannot just pivot back to internal combustion in 6 months because lithium got expensive. The production schedules are locked. The capital is deployed. The strategic commitments are made. Demand destruction in automotive happens over 18 to 24 months, not 18 to 24 weeks. Supply response is even slower. You don't restart a lithium mine in 90 days. You don't accelerate a brine evaporation process with money. You don't get permits, financing, construction, and production ramp in less than 3 to 5 years for greenfield projects. Even brownfield restarts take 12 to 18 months minimum. The supply response to today's prices won't show up in physical tonnage until 2028 at the earliest. Furthermore, the arbitrage drain is happening right now. It's not theoretical. The ships are loading. The containers are moving. The Western supply that would have gone to Detroit and Wolfsburg is being diverted to Ningde and Shenzhen. That's not a demand problem. That's a supply allocation problem. And supply allocation follows price. As long as China pays more, China gets the material. Now let's destroy the idea that futures markets can stop this. I've seen this argument before in other commodities. The speculators will short the futures, crash the price, and the rally dies. And yes, financial players can push paper prices around. They can create short-term volatility. They can trigger stops and liquidate retail positions. But here's the problem. In a physical arbitrage situation, a futures short is just a bet against logistics. It's a bet that the ships carrying lithium to China will turn around. It's a bet that Chinese buyers will suddenly accept lower quality material at lower prices. It's a bet that the $31,000 premium will disappear for no fundamental reason. That's not how physical commodity markets work. The shorts can manipulate the paper price all they want. They cannot manipulate the physical flow. And the physical flow is unidirectional right now. It's going east. If the skeptics are wrong, and I believe they are, the institutions only have a few moves left. They have to secure supply at any price, or they have to accept production delays. There's no financial engineering solution to a physical shortage. So what happens next? Let me walk you through what I expect to see over the next few weeks and months based on historical patterns and what I'm seeing in the data right now. First, automotive panic buying. I expect major OEMs to start announcing emergency lithium supply agreements at significant premiums to current Western spot prices. Watch for headlines like Ford secures strategic lithium supply or GM announces long-term offtake agreement. Those announcements will be disguised as strategic wins, but read the details. Look at the price per ton implied by the deal. It will be much closer to Shanghai levels than current Western quotes. That's the tell. That's the confirmation that the arbitrage is forcing a reset. Second, production guidance revisions. I expect at least two major automotive manufacturers to revise their EV production guidance downward for 2026, citing supply chain constraints and battery materials. They won't say lithium specifically because that would be too alarming. They'll use vague language about critical mineral availability or upstream supply challenges. But you'll know what they mean. Third, government intervention noise. I expect announcements about strategic lithium reserves, expedited permitting for domestic production, and emergency trade negotiations. Most of this will be theater. Governments cannot manufacture lithium any faster than private companies can. But the announcements will create short-term price volatility as markets try to price in policy impacts that won't materialize for years. Here are the specific indicators I'm watching. The dashboard. First, the $65,000 breakout. If Western lithium carbonate spot prices push past $65,000 per ton on any major exchange, the catch-up is official. That's the signal that Western markets are acknowledging the Shanghai premium and are starting to close the gap. If we clear $65,000, we're going to $75,000 fast, then $85,000, then $95,000. Second, the Chile export data. Chile publishes monthly lithium export statistics through its mining ministry. If the March data shows continued acceleration of shipments to China, the drain is confirmed and likely to continue. Watch for that report. Third, the battery cell contract renegotiations. Major cell manufacturers like CATL, LG, Samsung, SDI, they have supply agreements with automotive OEMs. If you start seeing headlines about contract renegotiations or price adjustment clauses being triggered, that's confirmation that the cost pressure is real and flowing downstream. And here's the pattern interrupt I need you to see. Look at the 14-month channel on lithium carbonate prices. From January 2024 to now, it's been a grinding decline from $70,000 to $53,000. Slow, steady, painful for producers. If we break back above $65,000, that downtrend is officially broken. There's no technical resistance until we hit the 2022 highs around $80,000 on Western exchanges. And if Western prices are running free toward $80,000, the Shanghai premium means we could see $110,000 to $120,000 on the high end. That's not speculation. That's just adding the current premium to a normalized Western price. The trap is set. The Chinese procurement managers know it. The Western automotive executives are starting to figure it out. The only question is whether investors and manufacturers position for this before the headlines force them to. And that brings me to my personal battle plan. What am I doing with my own lithium exposure right now? What am I watching for? What are my trigger points? I want to be very clear about something. I'm not here to tell you what to do. I don't know your financial situation. I don't know your risk tolerance. I don't know if you're holding lithium mining stocks or battery manufacturer equity or futures contracts or physical material. I can't give you advice, but I can tell you what I am doing with my own portfolio, and you can decide if any of it makes sense for your situation. I'm monitoring two specific triggers right now. Trigger A. If Western lithium carbonate clears $65,000 in the next 2 weeks, I'm interpreting that as the start of the Shanghai catch-up. At that point, I'll be looking to increase my exposure to lithium producers with near-term production and low-cost structures. Companies that can actually deliver physical material, not exploration stories, not development projects 5 years from production. Actual producing mines with actual inventory to sell. Trigger B. If the Shanghai premium compresses to under $15,000 without Western prices rising to meet it, I will reassess the entire thesis. That would suggest Chinese demand is softening or that supply is being found somewhere I'm not seeing. I don't expect this, but I'm watching for it because I want to be wrong early rather than wrong late. Now here's my hands clause. If we see major exchange rule changes or emergency government interventions that distort the physical market, I'm sitting on my hands. I'm not panic buying. I'm not panic selling. I'm not letting regulatory theater shake me out of a position that's based on fundamental supply-demand dynamics. This is critical. The whole point of government announcements is to create uncertainty, to make you doubt your analysis, to get you to close positions before the thesis plays out. If you're positioned based on physical supply fundamentals, a press release from the Department of Energy doesn't change those fundamentals. It just creates noise. And here's my personal rule, the one I will not break under any circumstances. I'm avoiding any lithium investment that depends on futures contract delivery. In a supply crisis, futures contracts become problematic. Exchanges can change margin requirements. They can force cash settlement. They can do things that protect the exchange at the expense of contract holders. Physical exposure, whether through producing miners or physical inventory, doesn't have that counterparty risk. When you own the rock, you own the rock. Nobody can margin call a mountain. And here's the thing that's been bothering me for weeks now. The thing I keep coming back to every time I look at these supply chain data flows. The window is closing. The choice is becoming binary. You either have supply secured or you don't. You either have physical access or you have paper promises. And in an arbitrage dislocation scenario, those two things are not the same. Paper can be printed. Paper contracts can be force settled in cash. Paper exposure can evaporate when the exchange decides the situation is too dangerous to allow physical delivery. Physical cannot. Physical sits in a warehouse or moves on a ship or gets processed in a refinery, and no margin hike, no regulatory change, no exchange rule can make it disappear. So here's what I'm asking you to do. Don't take my word for any of this. Go look at the data yourself. Pull up the Shanghai Metals Exchange lithium carbonate quotes. Look at the premium over Western spot. Pull up the Chilean Mining Ministry export data. Look at the destination breakdown. Pull up the automotive manufacturer production guidance and compare it to announced battery supply agreements. It's all there. It's all public. You don't need a $50,000 per year data terminal to see this. You just need to know where to look. And if you do the work, if you pull the data and you see what I'm seeing, then you have a decision to make. Are you going to position for this? Or are you going to wait for CNBC to tell you it's safe? Because by the time CNBC tells you it's safe, lithium will be at $90,000 in the West, and the arbitrage gap will be closed, and the opportunity will be gone. That's how this works. The mainstream financial media is not your friend in situations like this. They are there to keep you calm, to keep you in your index funds, to keep you from making sudden moves that might destabilize the portfolios of their advertising clients. I'm not saying they're malicious. I'm saying their incentives are not aligned with yours. My incentive is simple. I want to profit from this market, and I want to help other serious investors do the same. That's it. I don't work for an automotive company. I don't have a mining promotion to push. I don't have institutional clients who need me to stay on message. I'm just someone who has been watching battery materials for over a decade, who saw this dislocation forming weeks ago, and who decided to build this channel so I could share the information in real time instead of waiting for the commodity press to catch up. And I know some of you are skeptical of the AI avatar thing. I get it. It looks impersonal. It feels strange. But here's the reality. I can record a script like this in 45 minutes, process it, and have it live before the Asian markets close. If I tried to do this with traditional video production, camera setup, lighting, multiple takes, editing, rendering, color correction, it would take me 8 hours minimum. By the time I published it, the Shanghai premium would have moved. The shipping data would be outdated. The arbitrage math would be stale. The AI avatar lets me move at the speed of the commodity market. That's the only reason I use it. It's a tool. The analysis is mine. The data is mine. The supply chain contacts are mine. The avatar is just the delivery mechanism. So if you're still with me, if you've made it this far into the video, you're the target audience. You're the investor who wants real supply chain intelligence, who's willing to do the work, who understands that commodity markets are not a level playing field and that you need every edge you can get. You're the manufacturer who has been watching battery material costs eat into your margins. You're the analyst who has been looking at EV production targets and thinking there's no way the supply chain can support those numbers. You're my people, and I built this channel for you. Here's what I need you to do right now. Watch the Western spot prices today and tomorrow. Watch whether we break $58,000, then $62,000, then $65,000. If we do, come back to this video and leave a comment. Tell me what you're seeing in your supply chain. Tell me if your battery cell quotes are spiking. Tell me if your procurement team is panicking. I want to know what's happening on the ground because the data I see on commodity terminals is only half the picture. The other half is what's happening in the real world, in factory purchasing departments, in logistics operations, in emergency supplier meetings. That's the data the markets can't track, and that's the data I need from you. And if we don't break those levels this week, that's fine too. It just means the pressure keeps building. It means the Western market is digging in, refusing to let prices rise, continuing to lose physical supply to Chinese buyers who are willing to pay the premium, and maybe China backs off. Maybe their battery demand softens. Maybe some new supply source appears that I'm not tracking. I'm not going to pretend that's impossible, but I don't think it's likely. I think the demand is real. I think the arbitrage is real. And I think the Western supply chain is trapped. Now let's talk about the automotive piece of this, because I haven't even mentioned the downstream impact yet. The battery manufacturers, the KTLs and LG Chems of the world, they're the first line of impact. When lithium prices spike, their margins compress, or they pass the cost downstream. Either way, someone feels the pain. The automotive OEMs, they're the second line. When battery cell costs rise, vehicle costs rise. When vehicle costs rise faster than consumers are willing to pay, you get one of two things: margin compression or demand destruction. Neither is good for stock prices. The component suppliers, the charging infrastructure companies, the EV software providers, they're the third line. If EV production slows because of battery material constraints, everyone in the ecosystem feels it. Fewer cars means fewer chargers installed, fewer software subscriptions, fewer service contracts. This is a supply chain cascade. And it starts with that $31,400 arbitrage gap that opened up at 2:47 a.m. this morning. If you're holding automotive stocks, you need to be watching lithium prices more closely than you're watching vehicle deliveries. If you're holding battery manufacturer stocks, you need to be watching the Shanghai premium more closely than you're watching quarterly earnings. If you're holding lithium miner stocks, you need to understand whether your company is selling into Western markets at discount prices or has the logistics and relationships to access Shanghai premiums. The bottom line is this: the entire EV investment thesis depends on battery material availability, and battery material availability just became a lot more uncertain than your portfolio manager probably realizes. Now let's talk about what happens if I'm right, if the Shanghai premium persists, if Western prices catch up, if we hit that $100,000 to $120,000 range that the math is pointing to. What does that world look like? First, EV price increases. When lithium hits $100,000 per ton in the West, battery pack costs increase by approximately $18 to $22 per kilowatt hour. For a 75 kilowatt pack, that's $1,350 to $1,650 per vehicle. That cost goes somewhere. Either manufacturer margins shrink or sticker prices rise. Probably both. Second, production delays. If lithium supply cannot meet production targets, vehicles don't get built on schedule. Model launches get pushed. Delivery timelines extend. Customer deposits sit in escrow for extra months. Wall Street analysts start asking uncomfortable questions about guidance. Third, strategic panic. If the supply situation becomes acute enough, you'll see emergency government actions, strategic reserve announcements, emergency trade delegations, fast-track permitting for domestic production. Most of this will be too little too late to affect 2026 or 2027 supply, but it will create headlines and volatility. Fourth, M&A frenzy. If lithium supply becomes the bottleneck for automotive production, expect major OEMs to start acquiring lithium assets directly. We've already seen the early stages of this with GM's investments and Tesla's exploration of lithium extraction. If prices stay elevated, expect outright acquisitions of producing mines at significant premiums to current market valuations. So if I'm right, the $100,000 per ton scenario isn't the end. It's the middle. After $100,000, we could see $120,000, $140,000, maybe even $150,000 if the supply crunch becomes acute enough and panic buying sets in. But here's the thing you need to understand about commodity spikes. They end. They always end. And when they end, they often end badly. The 2022 lithium spike ended with a 70% crash over 18 months. The cobalt spike of 2018 ended with a 60% decline. This one will end too. And when it does, it will be faster and more painful than anyone expects. So if you're positioning for this thesis, you need to have an exit plan. You need to know at what price level you take profits. You need to know what percentage of your position you're willing to ride back down when the spike reverses. Because if you don't have a plan, you'll freeze. You'll watch lithium hit $120,000. You'll convince yourself it's going to $200,000. And then you'll watch it crash back to $60,000 in 6 months. And you'll end up right back where you started, except traumatized and gun-shy about commodities forever. Don't let that be you. Have a plan. Know your exit. Take profits on the way up. Don't try to sell the absolute top because you'll never time it perfectly. Consider selling a third at $75,000 Western price. Consider selling another third at $90,000. Let the last third ride and see what happens, or whatever variation makes sense for your risk tolerance. Just have a plan. And here's my final word on this whole situation. The data is the data. The Shanghai premium is real. The arbitrage is real. The physical drain is real. The supply-demand math for 2026 and 2027 is real. All of that is factual. What's not factual is where this goes from here. I can run the projections. I can show you the historical patterns. I can tell you what I think is likely. But I can't tell you what will happen. Nobody can. Commodity markets are chaotic systems driven by geology, weather, politics, and human psychology. Anything can happen. So take the information, do your own research, make your own decisions, and whatever you decide, do it with conviction. Don't half-ass this. Either you believe the thesis and you position for it, or you don't and you stay on the sidelines. There's no middle ground in a market that's moving this fast. Watch the $65,000 level. Watch the Shanghai premium. Watch the Chile export data. Watch the automotive supply chain announcements. And most importantly, watch whether physical lithium keeps flowing east. Because if China keeps paying $31,000 more per ton than the West, the supply keeps flowing to China. That's not analysis. That's gravity. Money flows to the highest bidder. Lithium flows to the highest bidder. And right now, China is the highest bidder by a massive margin. The Western terminals are quoting one price, the Shanghai warehouses are paying another, and the ships are sailing toward the higher number. That's it. That's the video. If you made it this far, you're serious about understanding this market. Subscribe if you want more real-time supply chain analysis. Hit the notification bell if you want to catch these updates before the mainstream commodity press figures out what's happening. And leave a comment telling me what you're seeing in your corner of the supply chain. Are your battery quotes spiking? Is your procurement team panicking? Are your suppliers asking for price renegotiations? I want to know. I'll see you in the next one. Stay sharp. The supply chain doesn't wait for anyone.